Stock's had a nice move, up 20% year to date. It still sits 18% below its 52-week high. You're looking for a move of 18%. So you're saying this stock has momentum to get back to its high, but then what?
I think you have momentum to get back to the high, but then I also think you have pent-up earnings power and pent-up stock momentum where we break that high. And I think you're looking at a risk-reward here where we could be talking 40 to 50% on the upside. And if I throw a 1 times peg to its 20% earnings growth trajectory that I think this company has for the next 3 to 5 years, I think you're looking at 10 to 15% downside from here, but potentially an up 50% scenario.
Josh Brown has a question for you, Matt.
Hey, Matt, have investors in this space traditionally been rewarded for buying stocks at 44 times earnings? And if not, what's different about this than other high-flying valuation retailers that you've seen before?
So I think a couple things. The setup in Five Below actually reminds me a lot of 2 years ago. So basically May of 2018, there was a lot of skepticism on the near-term trends. This time around, it's more on the tariff side. It's more on their pricing opportunity. You saw that stock move 40 to 50% in a month following the print. And I think you have a similar setup. I think 3Q is fine. I think there's a really nice 4Q and holiday opportunity here. They're raising prices for the first time in the company's history. And you have a licensing slate with Frozen 2. So you actually have a product allocation catalyst. So fundamentally, I think it sets up well. And from a valuation perspective, I think what's interesting here is for a 20% earnings grower with high visibility to that 20%, meaning this company is growing square footage. This is a unit growth story of high teens to 20%. Basically, a flat to low single-digit comp is building in at flat margins that 20% earnings growth scenario. So from a PEG perspective, 1.5 PEG, which is basically the average for growth retail across consumer, that's the scenario here for 40 to 50% upside.
Is the stock, well, is the company really getting, the business getting benefit from others' struggle in that exact space that they're in, not just broad retail, but where they're targeted?
Yeah, so, I mean, the two areas that we like in consumer, for not just through holiday, but also for next year, would be off-price and dollar and discount stores. Because I think what's happening with Five Below is you're right at the intersection between value and convenience. And one of the things I still believe is underappreciated with what Five Below has to offer is really the benefit from the consolidation across the rest of retail. So when you think of their 8 worlds and you think of toys and the consolidation in that space with Toys R Us, you think about in the home scenario and some of the consolidation that's happened there. You think about sporting goods and Sports Authority over the last couple of years. I think that they're benefiting from an 8,000 square foot box that generates a tremendous amount of value, not price, but value, in that they're selling iPhone cases and rechargers for $4 and $5, where you go to Verizon or you go to Walgreens, those are $20 to $30. So I think the relative value that they bring to the consumer is really that value convenience proposition, and they're squarely at that intersection, which I think in retail right now is exactly where you want to be.
Which is why I think, Shannon, you own Kohl's, Ross, and VF Corp. You have a question for Matt?
I do. Matt, are you concerned about the prevalence of kid and teen goods in the stores? Because I think that if you look at, from a competitive standpoint, parents going in there wanting to spend a meaningful amount of money, are you worried about, where you've seen something like Forever 21 go under that teen dynamic?
Honestly, I think the more disruption, the better. Now, number one in that scenario would be, you mentioned Ross stores. I think the off-pricers benefit the most in terms of availability of off-price goods and availability created from disruption. But I think as you think about the low end and more from the discretionary side, I think one thing that we didn't even touch on, the consumer backdrop here, I think is very strong into this holiday season, whether it's unemployment, whether you're looking at wages. So I think the backdrop is conducive to owning retail. I think the question is, where in retail do you want to place yourself? And again, I think disruption beneficiaries, I think, are here to stay for a multi-year period, because I still think we're in early innings of store closures and bankruptcies. So Forever 21 to me is just one of many that I think we're going to see continue to be the case for retail. And if you're delivering that value and you're convenient, and third, if you have innovation, I think you're right in the sweet spot for where you can continue to benefit from some of the larger picture things that are playing out across the space.
You have to be really selective, though, right? I mean, you just said the backdrop is conducive for retail, but yet your top holiday picks include only 5 of the 30 retail stocks that are in your coverage universe, and that is not many.
Yeah, I think that the key here is the consumer backdrop is solid, but I think retail will continue to be winners and losers, and you really need to avoid the potholes from a structural perspective. So department stores and specialty mall-based retail, we're still not there. Global brands were split, where I think there's opportunity on the athletic side as you look at a Nike, a Lululemon. You think about action sports with a VF Corp with North Face and Vans. You look in the off-price sector, we like that sector. I think there's an opportunity with Burlington. And then you look at the discount space, and I think the dollar stores and this pullback that we've recently seen on Five Below, I think sets up well. So yes, you need to be selective, but I think there's opportunity as you look at the state of the consumer today.
Matt, there's a lot of notes circulating in the last couple of weeks about the shortened calendar for the holiday season in a scenario similar to 2013. A name you're talking about today, Five Below, is specifically mentioned as one that's going to experience headwinds, as will Dollar Tree. Can you make us feel comforted that that is not going to be a concern, the shortened calendar?
Yeah, so if you look back to 2013, actually the biggest headwind that was faced in the retail sector is you had the condensed calendar, but far larger was the 2 weeks leading up to Christmas. There was substantial disruption from a weather perspective. So to me, the condensed calendar does heighten the risk that if we do get unfavorable weather, that creates store closures, that obviously that potentially becomes a larger risk. That said, I think a couple things. Number one, as you look at the overall consumer space, last year in December, if you remember, and I'm sure you remember it well, we had almost a 20% pullback in the S&P 500, and it more or less froze the consumer across the board. So you're lapping that, number one. Number two, the macro backdrop that we just talked about, low-income consumer from a wage perspective has had 3 years of minimum wage increases. On top of that, we have unemployment that's basically at a 30-year low. So underlying consumer backdrop, lapping the stock market change from a year ago. Yes, we have a condensed calendar, but I think that consumer's coming into the holiday with that set budget. And as long as we don't have weather disruption that creates store closures, I think that the retailers that are set up well are going to be fine in the fourth quarter.
What about mid-December tariffs? Quickly, I got to go, but how are you factoring that in? That's a real risk, no?
I think it depends company by company who has it in their guidance. So Five Below has fully tariff lists 1 through 3, as well as 4 in the guidance, both for this year and as you look forward from a pricing perspective. So I think it's company by company in terms of tariff impact, who's embedded it in guidance and who hasn't. But most companies from a pricing perspective, I think it's going to come down to who has pricing power. The Nikes, the North Faces, the Lululemons of the world have pricing power. Department store, private label, mall-based specialty, I think that's going to be a much tougher battle.
Yeah. Appreciate it, as always, Matt.